Hi there, Adrian here, mortgage broker based in Sydney. On this channel we talk about all things lending, investment and finance. On this video we're going to be going through three major changes happening at the moment in the last 6 months that have affected your borrowing power. So let's jump straight into it. Now the first slide that we've got here is ASIC and APRA coming into the market, which are government entities, coming in telling the banks that the property market's overcooked and let's put the brakes on lending. All right, so what they did was in late last year around August or September, they actually changed the rate that they stress test your borrowing power at. So I'll give you one easy example, and we'll use Commonwealth Bank as an example. In the past, before these changes, Commonwealth Bank had an interest rate floor that they stress tested your borrowing power at. All right, so I'll give you an example. Let's say you got a rate of 2.5%. What they would do is they would add 2.5% on top of that rate, so you go to 5%, and then they would check that against their interest rate floor. So the interest rate floor with CBA was between the last year was anywhere from about 5.1 to 5.4%, depending on when the changes happened. All right, so let's use an example of 5.1. So what they would do is they'd check the interest rate floor, see if the 2.5% on top of 2.5% is over and above 5.1, which obviously it isn't. So then what they would do is they'd run the borrowing power stress tested at 5.1%. So what they would do is they'd look at your current borrowing power at that rate, because from the bank's point of view, they want to make sure that they stress test your borrowing to make sure that you are capable of making extra repayments at the higher level if interest rates go up. All right, so that's what happened up until about August or September of last year. And then a lot of these changes came through. So ASIC and APRA came in and they increased the floor from 2.5% to 3%. Okay, and then every bank had to go into their book of loans and then have a look at where they would put their interest rate floor. So a lot of them just increased their floor from 5.1 to 5.3. Most of them were sitting around there, up 0.5%. So on a $1 million mortgage, we were seeing, this impacting your borrowing by about $50,000 to $70,000 in total. Okay, so that was the first change that happened. So some of the ways that people were getting around these rules or trying to get themselves in a better position to borrow more was, one, they were going to banks that looked at their income better. So I'll give you an example. Commonwealth Bank looks at investment rental property rental income at 70%, and for high density areas, some banks look at rental income at 60%. Okay, for high density areas like high density units. So what some people would do is they'll go to certain banks that look at the rental income at 80% or 90%, so then they can up their borrowing power that way. That's one way. Second way is if you were self-employed and your last year's tax return was much higher than your prior year's tax return. Okay, a lot of people were going to the likes of ANZ, CBA and Adelaide Bank that have really good self-employed policy to increase the borrowing power and use the last year's income, even if there's a big gap to the prior year's income. So a lot of people were going, started at the end of last year. They'd have to be a little bit more tricky on the banks that they went for and make sure that they're going to the bank with the best policy. So some other examples I saw were banks, clients that had bonuses higher than 20 or 30,000. Some banks cap the bonus that they'll use for the servicing because it is a secondary income source. So I was seeing a lot of that, especially people in the tech space getting large bonuses. We were having to go to certain banks, so then they would use all the bonus for the borrowing power. All right, so other people, what they did was they made sure they checked with their broker on where the interest rate floor is for the bank that was selected. All right, the difference between, say, a 5.8% bank and a 5% bank, it's only 0.3%, but it might increase your borrowing power 30, 40, 50 grand. So that's another thing. What else happened was a lot of the banks, after they got reviewed by APRA, they increased their living expenses floors. Okay, it's called HEM. It's a benchmark that the banks set for your living expenses. So what they did was they got reviewed by APRA. They found out that their floor rates were not high enough, and they increased those as well. So people were sugar picking banks on because when you go through their bank statement doesn't show anywhere close to what the bank is recommending their floor. If your living expenses per month is only 2,800, but the bank wants to use 3,400 because they're tighter than other banks, then that may decrease your borrowing power. All right, so this is the first thing that people started doing after this came through. All right, because obviously their borrowing power went down by 50 to 70 grand if they were on $1 million loan size, and they needed to find other ways to increase it. Second thing that happened was debt to income ratios. Okay, so you had debt to income ratios change quite a bit. So I'll give you an example. In 2020 and 2021 for the most part, and even going back to 2018. All right, we had a situation where debt to income ratios. I'll give you an example. Let's say you've got a $50,000 income, and you want to buy an owner-occupied property. Most people and most banks 2 years ago could get you up to 6 to 7 debt to income ratio, no issues. And there were some banks in the mid-tier space that could get you up to 8 very easily. Okay, and you even saw the likes of some of the big 6 majors go over a 7 debt to income ratio. So very easy to work out. You're looking at $50,000 income times it by 7. You're looking at borrowing power of $350,000. Okay, now after these rules and APRA and ASIC coming into the market, you're in a situation where a lot of the banks were limiting the borrowing power up to 6. Okay, so anything over 6, especially if you didn't have a 20% deposit, was much harder to get. All right, now obviously there's different ways. So some banks at the moment will go up to a 7 even in the large bank space at the moment. Okay, but if you wanted to go to an 8 now or even a 9, you can get that, but you have to go to a non-ADI bank. So a non-ADI bank is a bank that doesn't take deposits but gives out home loans, and these ASIC and APRA rules don't apply to them. So there's a couple of mid-tier banks that do a lot of investment lending that get your borrowing power up. You might pay 0.3 to 0.4% higher than the major banks, but the extra benefit in the borrowing power that you're getting is much higher. All right, so I think a lot of these rules are forcing people to stay away from the major banks and go to the mid-tier banks if they want to increase their borrowing power. So that's the second one that's really changed things in the last 6 months. And then the last one is interest rates going up. So if you couple this together with everything that we're seeing in the market, so you've got your current stress tested interest rates with 3% on top of whatever rate you're getting, and then obviously rates are going up. All right, so you're seeing a situation where borrowing power is eroded over time because interest rates keep on going up. So do the stress-tested interest rates, and so then the borrowing power comes down. All right, so a lot of people will get impacted by that over the next kind of 12 to 18 months, especially the investors that are trying to really ramp their borrowing power. So they'll have to go into your mid-tier banks and go for the banks like your non-ADIs and things like that enable you to borrow more. All right, so you can still get what you want. You've just got to go into the mid-tier banks that have slightly higher interest rates. And you're in a situation where even if you're going them before, you're still having your borrowing power reduced slightly anyway, the higher rates go. All right, so these are the 3 things that are impacting people at the moment in the last kind of 6 months regarding borrowing power, and that's some of the different ways that we've found to not get around those rules, but just deal with those rules, and then just deal with certain banks that apply those rules slightly differently, which is favourable to you. All right, so I hope this video has helped you. I am a mortgage broker based in Sydney. You can reach out to me on my calendar below, or my contact form, and we'll be in touch. I hope this video, you've liked it, and watch more videos on my channel. I'm trying to get that good information out there, and we'll see you on the next video. All right then, bye. And don't forget to like, subscribe, and comment. All right, you have a great day. Bye.